So the Bank of Canada just cut interest rates 25 basis points to a 2.5% overnight rate, but a kind of deafening silence coming from the typical choir of real estate professionals who usually come out with their posts and say, surely this is the rate cut that will resurrect the market. This is going to be the catalyst for house prices to come back. During these rate cutting cycles, typically as rates come down, people are optimistic because they saw the correlation on the way up that, rates going up cause prices to come down, and they feel like the market's very credit sensitive. Even people I know who are exceptionally qualified and well educated in this space were telling me that people were going to pile back into the market as soon as the rate cuts started. And the reality is that just hasn't happened, and it's probably not going to happen. And this is because the pain typically starts for borrowers and for the housing market after rate cuts start. If you go back historically, and you can see it in this chart by Ben Rabideau, the total number of delinquent mortgages typically rises during the cutting cycle or after the cutting cycle. And the reason for this, the Bank of Canada is typically cutting in response to negative economic data. And negative economic data means people are losing jobs, which means they can't pay their mortgages. And as rates come down, the first couple of cuts, people are optimistic about it. They think it's going to fix the market. But then, look back on the last couple of years, especially in markets like the GTA, you've got prices down 10% year over year at the same time that rates were getting cut. The other piece that I want to add in regards to the rate cuts is that it's pretty crazy for the Bank of Canada to be cutting with core inflation at 3%. And this is where you see a lot of the criticisms that they're reducing costs of capital while regular households are still experiencing a lot of stress from inflation. Basically, inflation is like a tax that redistributes wealth from the middle class. It inflates away the wealth of the middle class and redistributes it to the wealthy who hold assets and benefit from those lower costs of capital. Basically, the more good debt that you have at a low loan to value that's buying assets that are going up in value, the better off you are if inflation runs hot, because your debt gets inflated away and your asset values get inflated up. But the middle class is not in that position. They are most impacted by inflation, their costs going up on their household budget, and they have exposure to debt at typically a higher loan to value. The lower class or poor typically don't feel inflation as much because they're hand to mouth. Any money that they get, they typically spend immediately. And so it's very direct and they don't feel it. And so really inflation distributes wealth upwards in the economy. And even though CPI is at 1.9%, we saw that Statistics Canada was able to get their inflation CPI report out yesterday, one day prior to the Bank of Canada, which kind of, from my perspective, signaled that they wanted it out to substantiate some sort of thing the Bank of Canada was going to do. CPI is actually trending up. It's up to 1.9% on a year over year basis now, and it was only 1.7% last month. Another interesting part here, almost every Canadian bank and economist predicted that the Bank of Canada was going to cut rates, except for one, which was RBC. RBC's take that the Bank of Canada wasn't going to cut rates because of the inflation being high at that point, a lot of risk of push through from tariffs. But I did expect that they would change their tune as we started seeing negative economic data come out, which was more job losses. But because core inflation was sticky, I think they trusted that the Bank of Canada wouldn't make this move that many might consider to be a bit irresponsible. Core is sort of in the middle to the top end of their neutral range. Remember, their core neutral range is sort of 2.5% to 3.5% now. They've revised it upward a little bit. And so the correlation idea that realtors created in order to try and create this bull case that rate cuts would save the market has been completely erased. And what this does is it kills that consumer sentiment. The idea that rate cuts are going to save us goes away. And people realize with every new rate cut, with rates coming down, with lower cost of capital, with increased buying power for buyers, that the market's still not in recovery. And this is where you actually get to the point where, as you approach your terminal rate, which is the lowest rate that the Bank of Canada is going to cut to, by most banks' estimates, is about 2% on the overnight rate. So we're still about 50 basis points away from that. The market really starts to experience a fatigue or like capitulation. And it's not until after you've got through that capitulation phase that you can actually start to see a recovery. And so I'll leave you with this tweet that I put out in 2024, over a year ago, that said, at the beginning of the rate cutting cycle, that the real pain comes, especially in relation to the housing market, the real pain comes after rate cuts, when people realize that it's not going to save them. It's not going to save the housing market. It's not going to save Canada's economy. So where does this leave us when it comes to the Canadian housing market? From my perspective, rate cuts might make mortgages a little cheaper. It might ease some pressure for a lot of those people renewing mortgages over the next 2 years. And I've done many videos on the renewal wall or the great renewal that's coming. We have 60% of mortgages renewing by the end of next year. But falling prices, rising delinquencies, and increasing job losses are way bigger forces right now. So to imagine that rate cuts and even us getting to the end of the rate cutting cycle is the beginning of a new bull run is just very naive. This is way less the start of a new bull run or the start of a recovery, and much more a indication that the Bank of Canada is trying to soften a hard landing. So let me know what you think in the comments. Is the Bank of Canada cutting early enough to rescue housing or alleviate some of that pressure that I described? Or are they too little too late on this? Are you fearful that we might see a bit of a resurrection of inflation given that they're cutting with core at 3%? Drop your thoughts in the comments, hit like and subscribe, and check out my newsletter on Substack. The link's in the bio for a bigger breakdown. As always, thanks a lot for taking the time to watch this video. I really appreciate you taking the time out of your day, and I'll see you again soon.